What's up, traders? It's Mark Sebastian, your only option. Today, we're going to talk about what happened with the S&P, the Qs, the Dow, and the Russell 2000. We'll look at the VIX. We'll react to CRM earnings, preview Broadcom and non-farm payrolls. And, of course, I'll give you that one stock to be watching. So with that, let's dig in. There's still time to join Leisha's small account challenge. If you missed her and Hannah talking today, this is your chance to watch it. You can check out the video here. If you're watching me on YouTube, please like and subscribe. All right, let's dig in here. So the S&P, pretty nice day on Wednesday. I had kind of another weird one though. We opened up big, sold off, and then rallied about where we closed. As opposed to yesterday where we opened down and then sold off more and then actually rallied above where we opened. So the bullish kind of mantra of the market appears to be intact. Qs look pretty darn good as well. Part of that is because they've got that Google stock in there that is such a massive component. Google wins this court case. It was up 9%. This is one I've liked long for some time. I've been talking to you guys about liking Google and the opportunity to go long, as it is by far the cheapest of the Mag 7s or the Grade 8, whatever you want to call it. I still like it here. Maybe give it a day to see if it takes a little breather before starting to swim in the waters. But Google driving the S&P and the NASDAQ higher. The Dow Jones, which does not have Google in it, off a touch, but not very much. And the Russell 2000 closed pretty darn flat and then up a little bit after hours. After the bell, we did get CRM earnings. It's down 4%, which sounds like a lot, except the market was looking for almost twice that, 7.73%. So CRM down, but not crazy down, and it was up $4 on the day. So net, we're talking about 3%. Not a massive move at all. We'll see if there's some follow through in the morning, but this one seems like a dud. Ahead, now Salesforce is today. The big one going tomorrow, or today if you're watching this on Thursday, is Broadcom. Broadcom is now over $300. Typically, the market prices in about a 5% move. They're pricing in a 6.05%. That's a little closer to where it's been recently. And I would point out that outside of last quarter, it ran an entire year of meeting or beating this straddle price. So this one can move. It can fly. And if you look at how it performed last earnings, took it on the chin and was higher than where it was before those earnings by, call it about 10 days later. So Broadcom sells off, probably an opportunity to jump in there long. Speaking of things that are saying maybe go long, look at the VIX, back down to 1635 after a really strong couple of days. That term structure is in a nice contango. The spread between VIX and the September future is pricing in non-farm payrolls. That's why the VIX is holding up as much as it is. And VIX futures and that spread are so tight is markets are looking for a less than muted move on the volatility index ahead of that major report. So what is that major report telling us? Let's look at SPX options and see what they're pricing in for next Friday. For next Friday, the at the money option is about 650. That's 2 days. They're pricing in, traders are pricing in, call it $54, less than 1%. Remember, VIX looks at 30 days. This is a 2-day trade. What has our theme been? Near-dated options too cheap, long-dated options too expensive. It appears to be that way again. We have the 650 straddle trending around $54, $55. That's 2 days, including Broadcom earnings and non-farm payrolls. Call it 0.8%. Doesn't seem like much, does it? Especially when you consider we had a 100-point move on Tuesday. We rallied $32 on Wednesday on really no news and had a $30 plus range. There's all kinds of opportunity there, folks. Near-dated options are consistently too cheap, and you need to be taking advantage of that. How can you do that? Well, if you don't like owning a bunch of premium, buy near-dated options and sell something long-dated against it. How do you do that? Well, it's a little trickier for retail traders. Pros know what they're doing, but retail traders, there's some easy ways to do it. You can do longer-dated iron condors against owning some near-dated strangles and straddles. And if you don't know what those are, then you need to watch a lot more of this channel. But just know that an iron condor is kind of like betting the under for a football game. You're selling a spread that makes money if the S&P stays in a range. And then buying near-dated options, buying that straddle or strangle, that's buying the over. You're looking for movement greater than the total points. Again, near term, that point spread is too low. Long term, that point spread is way too high. All right, folks. Once again, make sure you are checking out Leisha and her small account challenge. If you're watching me on YouTube, you can click that link here. If you're watching me on YouTube, please like, subscribe, leave a comment. I will answer. I am Mark Sebastian. I am your only option. Have a good one.